Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. Facebook rebrands and Metaverse cryptos expand. Decentraland and the Sandbox pump following Facebook's Metaverse push. How high could these cryptos realistically go? Shiba Inu explodes. The Dogecoin killer briefly dethrones its master as it pushes into the top 10. Who is the mysterious SHIB billionaire everyone is talking about, and why haven't they sold? Tesla teases a reinstatement of Bitcoin payments. A recent SEC filing suggests this could be the case, and if it is, when will we see it happen, and what could it do to the crypto market? XRP is coming to Ethereum. Wrapped XRP is in the works, and it could be what Coinbase needs to relist XRP. Why this announcement can't be ignored. Banks beg to hold Bitcoin. Regulators around the world scramble to clarify crypto custody for private banks. Is this what we need for a physically backed Bitcoin ETF? Tether falls in line with the FATF. USDT transactions will be closely tracked in accordance with the FATF's recommendations, including the infamous travel rule. Here's what that means for you. The US Treasury gives stablecoin powers to the SEC. The unprecedented move could spell trouble for certain stablecoins. Which ones are at risk? Infrastructure bills imminent. The two spending bills that give crypto holders chills could be passed by US politicians as soon as tomorrow. What happens if they do pass? And a closer look at the continued correction in this week's crypto market forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. Facebook CEO Mark Zuckerberg has revealed the social media company's new name, Meta. The name change is supposed to symbolize Facebook's shift in focus to the Metaverse, i.e. immersive virtual worlds, which Mark believes will be the future of, well, the world. As many crypto personalities have rightfully pointed out, Facebook's Metaverse play seems to be a part of its crypto push. For those who don't know, Facebook first started dabbling in crypto back in 2018, when it announced its Libra stablecoin. Libra has since rebranded to Diem, and if you watched my video about it, you'll know that it's basically dead in the water. This means creating a crypto for payments is effectively off the table for Facebook. Facebook can't do DeFi either, for obvious reasons, so that leaves one last crypto niche, NFTs. Lo and behold, it looks like Facebook's Metaverse will be filled with them. And not only that, but Facebook's Metaverse looks eerily similar to the crypto-powered virtual worlds of Decentraland and the Sandbox, which also have their fair share of NFTs and in-game economies. If Facebook is rebranding itself to build exactly this kind of product, then it stands to reason that this kind of product is in demand, or at least will be in the not-so-distant future. I reckon this is the reasoning that drove Mana and Sand to new all-time highs, but it looks like they've already begun to fall out of the sky. I'll do a more in-depth price analysis of both at the end, so stay tuned for that. The only other crypto that pumped as hard as Mana and Sand last week was none other than SHIB, and this is how I think that happened. Bitcoin had hit a new all-time high the week prior, meaning crypto was back in the news. This saw the return of run-of-the-mill retail investors looking to make a quick buck. Given that SHIB has the lowest price tag on Coinbase, I reckon many of these retail investors thought, what the hell, I'll throw in a couple of $100, why not? After all, Elon Musk is involved with the project, right? This pumped up the price of SHIB, and the initial pump was then accelerated by the Shiba Inu community, who seemed to be getting close to convincing Robinhood to list SHIB. In the middle of all this madness, Elon came out and said he doesn't hold any SHIB, but this was quickly swept under the rug as the gains were just too good for reason to ruin. Once private businesses began announcing they would be accepting SHIB as payment, it became clear that the top was in. This begs the question of why one mysterious SHIB billionaire never took profits, and Joe Brown over at Heresy Financial seems to have hit the nail on the head. Whoever bought $3,400 worth of SHIB last August has either lost access to their wallet or has convinced themselves that SHIB will keep going up, meaning they probably won't be selling anytime soon. In either case, this is good news for regular SHIB holders who are rightfully nervous about the crash that could happen if this absolute unit of a SHIB holder began to sell. Now, in terms of who this SHIB holder might be, I reckon it's reasonable to assume that it was someone close to Shiba Inu's creator, Ryoshi. Now, the rabbit hole there goes deep, and you can learn about it by watching my first video about Shiba Inu using the link up there in the top right. Now, back to Elon Musk. I mean, it just wouldn't be the weekly news without him, right? A recently uncovered SEC filing made by Tesla in September suggests that the electric car giant could soon begin accepting Bitcoin payments again. This is because the SEC filing specifies that, quote, "we may in the future restart the practice of transacting in cryptocurrencies." For context, Tesla briefly accepted Bitcoin payments earlier this year before it dropped them in mid-May over environmental concerns. This was one of the many catalysts of the crypto market crash around that time. Elon had noted earlier that Tesla would begin accepting Bitcoin payments again, once most of the energy in Bitcoin mining is coming from renewables. Now, as I've mentioned many times, I believe this threshold has been crossed, and I personally think we could see Tesla begin accepting BTC payments at any time. The effect this would have on the crypto market would be quite profound, as it's likely that other companies would follow suit, especially if Tesla's stock continues to perform the way it has. Now, while this would not have a direct effect on the price of BTC or any other cryptocurrency, the additional validation it would give to crypto as an asset class would have ripple effects the way the Bitcoin Futures ETF has. Speaking of ripple effects, it looks like XRP is coming to Ethereum thanks to a partnership between Tokensoft and Hex Trust. Tokensoft is the company behind a bunch of wrapped ERC20 tokens, including wrapped Bitcoin. All Tokensoft wrapped coins require a custodian, and in the case of WBTC, that's BitGo. For WXRP, Tokensoft has tapped Hong Kong-based Hex Trust as the custodian, and the first WXRP tokens are expected to land on Ethereum sometime in December. As I mentioned in my recent video about the SEC's lawsuit against Ripple, it appears as if Coinbase could relist XRP as an ERC20 token. This is because Coinbase has listed a handful of cryptocurrencies which the SEC would likely consider to be securities, which is what they claim XRP is. It looks like Coinbase has managed to skirt the SEC's regulatory scrutiny by listing ERC20 versions of these cryptocurrencies. If I'm correct, this means Coinbase could potentially relist XRP as an ERC20 token, and it has every incentive to do so because XRP is one of the most traded cryptocurrencies, and most XRP holders live in the United States. We will find out when December rolls around, and if Coinbase does relist XRP as an ERC20, this could have some pretty crazy implications for other cryptocurrencies that can't list on US exchanges. This is because XRP's ERC20 listing would confirm that this regulatory loophole does in fact exist, and we could see many other cryptos start wrapping themselves to be listed on Coinbase as well. Now, of course, all this is just my speculation at this point. If you happen to be curious about whether Coinbase could list your favorite cryptocurrency, I have a whole video about that, which you can find up there in the top right. As much as the absence of clear crypto regulations has benefited some cryptocurrencies, it's clear that this has proven to be a major concern for institutions who are looking to get involved in crypto. Oddly enough, the banks are craving crypto the most, primarily because they can see all the billions flowing out of their client accounts into cryptocurrency exchanges like Coinbase and DeFi protocols like Aave. The only way that banks can compete is by offering crypto services in-house, and the crypto services banks are the most desperate to set up relate to custody. As I mentioned in last week's crypto review, Spanish banks have been waiting for clarification about crypto regulations from the Spanish central bank, and it looks like they finally got this clarification. US regulators recently noted that they will be aiming to clarify custody regulations in the coming months, and once they're hammered out, the SEC could have the infrastructure it needs to approve a physically backed Bitcoin ETF. This sentiment is further supported by the fact that Australia's own securities regulator specified that regulated crypto custody is a prerequisite to approving a physically backed Bitcoin ETF, something which they're willing to do due to institutional demand. Interestingly, the cryptocurrencies that banks want to custody the most are stablecoins, and this is due to the insane institutional demand for the free market interest rates they find in DeFi. It seems that as stablecoins become ever more important to investors, the centralized entities which issue them are becoming ever more compliant to regulatory demands to keep the ban hammer at bay. The most recent example of this is Tether's partnership with Nota Bene to enforce the FATF's infamous travel rule on USDT transactions. Now, if you watched my video about the FATF's crypto recommendations, you'll remember that the travel rule means tracking every transaction worth more than $1,000. This involves collecting KYC on both counterparties in any transactions around this threshold and reporting it to the relevant authorities. Now, as far as I understand, Tether's travel rule tracking is only in its testing stages, and it will only apply to USDT transactions made between two virtual asset service providers, or VASPs, i.e. cryptocurrency exchanges. This means peer-to-peer USDT transactions exceeding $1,000 won't be tracked by Tether, at least not yet. The FATF's updated crypto recommendations seems to imply this could eventually be the case, and I'll be doing a deeper dive into that possibility in a video later this week. If the FATF's travel rule does find its way to peer-to-peer transactions, it wouldn't be far-fetched to say that we could see Tether freeze any wallets holding USDT that haven't completed KYC on its platform. This underscores the importance of decentralized stablecoins such as Terra's UST, which you can learn about, using the link in the top right. The pressure to transition away from centralized stablecoins is only increasing too. Besides the FATF, US regulators are finally starting to make some moves. According to Bloomberg, the US Department of the Treasury has given the SEC the authority to regulate stablecoins. This is a problem because SEC Chairman Gary Gensler has said on many occasions that some stablecoins are securities, like stocks in a company. This is a bit strange because there is no expectation of profit coming from holding a stablecoin because stablecoins are, stable in value. Gary's take seems to be based on the assets backing the various stablecoins in circulation, something which I also covered in a video a few months ago. If you watched that video, you'll know that most stablecoins are backed by some kind of debt, be it government or corporate debt. Because bonds are securities, if stablecoins are backed by bonds, the SEC probably considers them to be derivatives of securities. It's complicated, I know. The stablecoin that is most at risk is obviously Tether's USDT, which is backed by a whole basket of interesting assets, including risky short-term corporate debt that may also include Chinese developer debt. In theory, Circle's USDC and Paxos's USDP should be safe, given that they're both backed by cash and cash equivalents, which is of course code for short-term government debt. This brings me to the two spending bills that could finally be passed by US politicians tomorrow: the infrastructure bill and the so-called human infrastructure bill. The infrastructure bill totals $1 trillion, plus or minus a few hundred billion, and it contains two clauses that could be problematic for crypto. The first is a vague definition of what a cryptocurrency broker is, which could force certain individuals and institutions in crypto to collect KYC information about individuals and institutions they interact with for tax purposes. The second is the requirement to collect KYC information about any counterparty in a crypto transaction worth more than $10,000, something that is obviously impossible to do for things like DeFi protocols. Now, the human infrastructure bill totals $2 trillion, plus or minus a few hundred billion, and it was apparently rebranded to the Build Back Better bill after they shaved $1.5 trillion off the initial sticker price. Anyways, the only effect the Build Back Better bill is expected to have on crypto relates to tax loopholes involving complex derivative trades that I'm sure none of you are doing on a daily basis. Now, that said, the US Treasury was apparently trying to add additional tax reporting rules for cryptocurrencies to the Build Back Better bill, back in August, and it's unclear if they succeeded. After all, these bills are thousands of pages long, and another anti-crypto provision could have been added without anyone noticing, as was the case with the second provision in the infrastructure bill. The good news is that the crypto market seems to have shrugged off most of this FUD for now, but the cracks are starting to form and we could be in for a short-term crash. As you can see, BTC has been trending downwards over the last week, and so has most of the rest of the crypto market. One of the few exceptions here is ETH, which managed to hit a new all-time high following the Altair upgrade, something I predicted last week, just saying. Although BTC and ETH are still looking strong, the more they test those lower ranges of short-term support, the more likely they are to be broken. Upcoming events creating uncertainty for the crypto market, such as the aforementioned stablecoin regulations and spending packages, suggests this will happen and could give us a modest 5% correction. However, if we are about to repeat the same Wyckoff pattern we saw back in April, we could see an unexpected move to the upside, something which is also very possible given all the bullish announcements waiting in the weeds, such as Tesla's re-acceptance of BTC. The first half of each month also tends to be bullish for the crypto market. As such, it's a bit of a coin flip, but I prefer to keep a bearish bias when everyone is greedy, as revealed by the Bitcoin Fear and Greed Index. If you need any more evidence of greed, look no further than the returns on this week's winners: Decentraland, the Sandbox, Shiba Inu, Basic Attention Token, and Engine Coin. Starting with Decentraland, Mana pulled a 5x in 3 days, and this is insane when you consider Mana's massive market cap. Now, normally I'd slap on a few indicators to tell you where Mana is headed next, but I think it's quite clear. The moon mission was successful, and it's time to head back down to Earth, specifically around the $1 mark. It's a similar story with the Sandbox, with Sand pulling more than a 3x in 3 days, and now it's riding the elevator with Mana down to the $1 range. Conversely, SHIB has begun a much slower decline from its 3x move as the dog-related hype wears off and retail traders realize it's time to take profits, notwithstanding any sudden bullish announcements that bring the apes back in. As for the Basic Attention Token, it looks like BAT got taken along on the ride with all the other Metaverse-related cryptocurrencies. Now, it's not entirely clear why, given that BAT is not related to the Metaverse, and there aren't any announcements I could find that could have caused its 2x pump. I should note that BAT has performed quite poorly compared with other cryptocurrencies, despite the fact that it's related to the amazing Brave browser, which has tens of millions of users and counting. From where I'm standing, it looks like BAT will settle back down to 70 cents, where it will stay indefinitely until some sort of strong demand drive for BAT can be created by Brave. And lastly, we have Engine Coin, a logical weekly winner given its involvement with various Metaverse projects. ENJ barely squeezed out a 2x last week, but experienced a lot of profit-taking as it approached its previous all-time high. In contrast with the other weekly winners, ENJ should settle down somewhere around the $2 mark, which is just a 20% loss. More importantly, ENJ is in a sustained uptrend, which means new all-time highs will come in due time. Until then, you can learn more about Engine Coin by watching my video about it. And you already know where to find it, folks. Yep, it's up in the top right. And that's all for today's Coin Bureau Weekly Crypto Review. So, if you enjoyed it, folks, you know what to do. Hit that like button, subscribe button, and bell icon too. If you want more of me, head on over to Twitter, TikTok, and Instagram to get a sneak peek behind the scenes. If you join my Telegram channel, you'll get the daily crypto updates you crave, and signing up for my weekly newsletter is a great way to get the tools, tips, and tricks you need to get paid. And of course, you can support the channel by heading over to the Coin Bureau merch store and picking up a shirt or hoodie or both. Links to all these resources are in the description. Thank you so much for watching, and I will see you all in next week's episode.